Hello, everyone. Good morning. Now that we have understood the basic concept of what a company is, what shareholding means, what shares are, let's try to understand what share market is. Let me revise first. Shares means nothing but a partial ownership in the company. So when you buy a share in certain company, you are buying a certain partial ownership of that company. Now, when you buy, we also talked about it that when you buy ownership in the company, the only way out in general private company, when you even when you start a business, you put certain money in that. You are owner, right? So how will you get back your money? There are only two ways. Either you withdraw some profits from the business, or you shut down the business and sell all your assets, pay off your all liabilities, and whatever is left is your money. Only two ways you can get back your money when you start a business. Similarly, in case of companies, when you invest as an owner of the company, there are only two ways when you can get your money back. Either company decides to pay its profit in form of dividends. Dividend is nothing but a share in profit that company decided to pay out to its owners. It is not mandatory because ownership company company may decide not to give away its profits but rather use them for further growth. If the company has, for example, you started business with 1 lakh rupees, the company has achieved 10,000 rupees of profit that year. Now that 10,000 rupees, the company can either decide to give away to its shareholders in their ownership proportion, or the company can decide to use that profit for its scaling up the business. So the dividend is not mandatory, but that is one way owner can get his money back. Another way the owner can get his money back is when the company shuts down the business, it completely liquidates, it sells off its all assets and pays off its all liabilities. That meaning sells its own property, everything that it owns, and pays off whatever it owed it owes to someone else, like for banks or creditors. Then whatever is left will be shared between all the shareholders. That is another way of you getting your money back. Now it was very illiquid. Like you can't expect to when you invest some money in somewhere, for example, FDs, you invest that because one, it should grow in a certain percentage. Like you want some returns, 8%, 10% on it, and another point is you want to withdraw it whenever you want. Nah, so investing in a company, if there is no liquidity option, why would anybody invest in a company? Like if the company has giving me if the company decided not to give me dividend, and it also decides that it will go forever, because life of company is unlimited. There is no limit to the age of company. Companies can go forever and forever because it's a separate legal entity and it is unalive, right? So it can go forever. So unless the company decides to start a business, stop the business, I am not getting my money back. So why would anybody invest in that company? Now there comes the term of share trading. What it means is when you have certain percentages of share ownership in that business, you are now able to sell that share to somebody else who is willing to buy it. For example, let's continue our example here that your 10 friends came together, float a company, bringing 10,000 rupees of capital. Now the share capital is 1 lakh rupees. Your share has value of rupees 10,000. Now over the years, company earn profits of say rupees another 1 lakh rupees over the years, 10,000 rupees, 10,000, some 20,000, some 30,000. The company earned profits of rupees 1 lakh rupees over the years. Now the total capital base, it was earlier 1 lakh plus 1 lakh rupees of profits, it became rupees 2 lakh. And you are a 10% shareholder in that. So your value, the share value of your share in the company has become 20,000 now. Now, if you want to exit that business, either it has to be one way that company decides to pay off all that profit to you in form of dividend, or the company decides to shut down and you will get that money back. Now, the third way is if you want to sell that share in ownership, and if you find somebody that there is another friend of yours who want to be in that business, who want to also invest in that business, he can buy that share from you. For example, now the value of your share is 20,000. No, you both can negotiate and come to a certain point. Say you are saying I want 21,000. He says I want for 18,000. Now it depends on demand and supply. Whose will is stronger? You will come at a certain point, and that point you will sell your share in that business to that person, and that way you will get your money back. Now, when we are talking about this small example, when there are only 10 shareholders, this example seems very illiquid. But in case of big companies like Reliance, there are crores of shareholders. There are lakhs and crores of shareholders every day who are willing to buy and sell the share at certain price. So there is high liquidity. You can buy it whenever you want. You can sell it whenever you want. So the underlying purpose of your investment now has become and you buy it at a certain price and expect the price to go up as the company makes more and more profits, and they'll sell that share to someone else who is willing to buy the share at that price. Now, how will you do it? There comes the stock exchange. I will start with how the stock exchanges began initially. Then we will talk about the current share markets tomorrow. The stock exchange initially started actually in 1850s under a banyan tree. वडाचं झाड म्हणतो ना आपण. Under a banyan tree. It literally the stock exchanges now we see so big. They literally started under a banyan tree. At that time, as British ruled over us, there were many cotton mills at that time, and they used to give they were public companies where they have raised money from public to start the mills. So the shares of those company were used to trade under that banyan tree. The people used to come, the shareholders who are willing to sell their share in the mills used to come under that tree. The people who want to buy the share in that mill used to come under there, and they used to talk there and decide price, and buy sell used to happen. Now this thing is scaled to a very huge level in form of National Stock Exchange and Bombay Stock Exchange. Now what is this? We will talk about it tomorrow. Thank you.